Okay, this is the day before Thanksgiving, and this is something I hope you'll watch before class resumes on the Monday after the holiday. What do we have here? We have two K1s, all from the same partnership, and this is just to give you an illustration of all the things we've been talking about ad infinitum in class, so you can see up front and personal how it looks. The names have been blotted out to protect the innocent, but it seems to be that you could look at it that this particular person, this particular owner in the entity is a 50% owner, which we see there, no problem, and they must be, for one reason or other, it's not absolute that it has to be this way, but it seems to be apparent that they're probably the managing member because the address for the entity looks like it's the same address for the individual. This is the entity address here, the partnership, and this is the partner. And right now we're looking at a 50% owner, as I said, and notice, concentrating first over on this side, the allocation side. Now we know something more about this particular partnership. We know that it is indeed that's right, it's a rental property of some sort. It's got rental income. That's why it's on this line, net rental income. In this case, it's a loss, which is typically found because you're going to see that you had depreciation on the property in excess of the other expenses, creating and in excess of the income, creating a loss. Not bad, because cash flow is probably positive, so partners could be pretty happy. There are occasions when there's a drain on cash flow, but your property's appreciating in value. This is the whole real estate industry. You can get the idea from just your basic idea of what business is all about and how businesses make money. So what we have down here at the other information on the partner, well, we actually have quite a few information. First of all, we get to see that the partner is an individual as opposed to any other type of entity. We see that their beginning percentages were 50%, but their ending is 50%. And notice, how will you notice? I'll show you. Notice that you got the three different types of ownership. We've got the profit, got the loss, got the capital, and the percentages are left there blank for you to fill in, and you could fill in whatever the case may be. As I said, it could be that the capital amount could be 0. That's a possibility, or any of the others, and the percentages could be 100%. It all depends on the agreement. The most important thing, I think, or at least that I wanted to emphasize here, was the fact that you've got qualified non-recourse financing being allocated to the partner, and recourse financing. We spoke about what those both things are in class, and you would know that you must be in a real estate deal when you see qualified non-recourse financing. And look how huge a number it is. Obviously, mortgages can come in any shape or size or variety. In this case, it's a fairly decent sized mortgage. And this is only half of it, because they're only being allocated half the mortgage here. The recourse debt is also added. And if I asked you, by showing you this form, what's the outside basis, knowing that the person came in and there's been no, came in initially with the partnership and did not come in by buying somebody else out, which the transaction wouldn't go through the books of the partnership. So all the partner's capital in this case is from day one of the agreement, from day one of the partnership. It's not from any outside source. So you can actually come up with the outside basis by adding in the qualified debt and the recourse debt to the bottom line over here. After all, this is the partner's capital account analysis, and so we can look to that to figure out where we are. But it's not enough. If the outside basis, we have to then add this in, And that's what we would do. And we get a pretty high basis for taking losses. So you can see that even though in this return they show a $48,000 loss, it would be, for wealthy individuals, may not be a hard item to put onto the return and yield some tax savings by taking the loss this year. Of course, this could be passive to the individual, and there are special rules on passive income where you cannot take the deduction in full or at all depending on your other tax attributes, or it might be a active activity as opposed to passive. And if it's active, or what the better terminology, the more traditional terminology, is that the partner materially participates. And if that's the case, then you may have a lot more to write off than meets the eye. The other partners on the next page, and you can see that this particular partner lives in Chicago. Here's the address of the main entity, and that's all okay. And now we can fill in the blanks of what the partnership agreement must look like, because we see that this other individual is also 50% all the way. So now we know that the deal is indeed 50-50, as opposed to anything else it could be. Thusly, we see the same debt allocated to this partner because they're 50-50. This indicates something else. We'll come back to that. But the net loss from real estate is the same as it was on the other partner's account. Keep in mind that it's $48,000, and we'll go see that $48,000, so it's the same right there. All right, I've made a mistake, and how flawed a fatal mistake is it? If anybody can tell me. And that is that we're showing a capital account here of $1,200,000, whereas this other partner, presumably 50-50, is showing a lot less number. Is that good English? No. It's showing a lower number. So how is that? Well, it's fine because we have one partner maybe putting in more. In fact, you can see the more that came in right here, $895 in 2015. This is a 2015 return. And the amount that this partner put in was much smaller, and so their capital accounts wound up deviating by the end of the year. And that'll be something that we'll just have to watch. The book accounts versus the capital accounts. We'll just have to watch how this moves and make sure that at the end of the day, the allocations match the capital accounts such they get to zero. Both of them should be at zero at the end of the day. And if we have to allocate income or losses accordingly to get them to both to zero, we've demonstrated how that works in class, and that's what we would do. But we now see that differentials in capital accounts happen in real life, just like you saw in class. It wasn't just purely academic. All right, if you have any questions on this, send me an email or ask in class next week.